ExxonMobil is laying off 2,000 people globally. The company calls it restructuring. But buried in that number is a critical detail. 250 of those jobs are disappearing from a call center in Moncton, Canada. At the exact same time, Exxon is actively hiring and consolidating its most critical operations into a massive new hub in Houston, Texas. This isn't a coincidence. This is a symptom. While legacy companies like Exxon, Chevron, and ConoPhillips are reportedly scaling back their Canadian footprint, the United States is experiencing an energy boom of historic proportions. You are seeing two neighbors side by side with similar resources. One is choosing stagnation, the other is choosing dominance. This is the story that the mainstream media is not connecting. We are witnessing a great energy divergence between the United States and Canada. And let me be clear, this is not happening because Canada ran out of resources. It is happening because it is running out of patience for its own most valuable industry. This divergence is being driven deliberately by policy. In this video, we are not just going to report the news, we are going to follow the money. I will show you the hard data, the verifiable proof of why billions of dollars in capital investment are fleeing Canada and flooding into the United States. And more importantly, what this massive transfer of wealth means for your job, your community, and the entire economic future of North America. The Canadian chill. Why is Canada becoming toxic to investors? To understand what is happening, you must first understand a simple fundamental truth. Capital, money, is not patriotic. It is not loyal. It does not care about feelings. Capital is a coward. It only goes where it is safe, where it is welcome, and where it can grow. And for the last decade, Canada has systematically dismantled the very environment that capital needs to survive. It has become, for many global investors, toxic to investors. The first and most significant driver of this capital flight is what I call the war on certainty. For any CEO to approve a $10 billion 20-year project, like an oil sands operation or an LNG terminal, they need to know one thing. What are the rules? In Canada, that question has become impossible to answer. Take the infamous Bill C-69, the Impact Assessment Act. On paper, it was about environmental protection. In reality, it created a bureaucratic nightmare. It created a vague, unpredictable, and seemingly endless approval process. It injected uncertainty into every single stage of development. Timelines stretched from 5 years to 10. Legal challenges became the norm, not the exception. It effectively gave any administration the power to kill any project for purely political, rather than economic or scientific reasons. Now add on top of that the federal carbon tax. Again, this is not a debate about the idea of the tax. This is an analysis of its consequence. When you force your domestic energy producers to pay a heavy premium on every barrel they produce, a premium their global competitors do not pay, you are deliberately making them uncompetitive. You are punishing your own team before they even take the field. But the real poison pill here isn't just the tax itself, it's the uncertainty of it. Global investors cannot plan. They cannot model their 20-year returns when the primary cost, the tax, is subject to change with every single election cycle, with every political whim. Capital hates uncertainty more than it hates taxes, and Canada has mastered the art of uncertainty. This leads to the second major driver, the war on infrastructure. Canada has one of the largest, most ethically sourced energy reserves on Earth, but it has systematically choked off its own ability to get that product to market. Let's look at the graveyard of pipeline projects. Energy East, a $15 billion project, canceled. Keystone XL. While its final death was signed in the U.S., the project was delayed, attacked, and politically paralyzed within Canada for over a decade. And then there is the Trans Mountain expansion. This is the one project that was approved. It became so politically toxic that the federal government had to buy it from the private sector, a stunning admission that no private company could rationally build it. Its budget exploded from an initial $7.4 billion to over $34 billion. It took a decade of brutal legal and political warfare to get built. What message does this send to a global investor? It says that in Canada, even if you get approval, you will be fought, you will be delayed, and you will be bled dry. You create a self-inflicted bottleneck. You cannot sell a product you cannot ship. This is like owning the world's largest grocery store, but refusing to build a front door. Finally, Gashmernari, you have the political signals themselves. You have prominent leaders in Ottawa openly speaking about phasing out the oil and gas industry. Think about that. Imagine you are a global CEO, and the government of a country is publicly stating its intention to phase out your entire sector. Would you invest $20 billion there? Or would you take that money to a place that is actively asking for it? This is not economics. This is ideology-driven policy. When you combine a hostile regulatory environment, a war on infrastructure, and openly antagonistic political signals, the result is not a surprise. It is a calculation. The result is the Canadian chill. Investors are not just hesitant, they are leaving, and they are not looking back. The American boom. Red carpet rolls out in Texas. Now, let's look south of the border, because this great divergence is a story of two opposing philosophies. While Canada was building walls of red tape, the United States, and specifically the state of Texas, was rolling out the red carpet. The American strategy is what I call policy first. They view energy not as a moral liability, but as a strategic asset. It is the foundation of their economic strength, their national security, and their geopolitical power. And they treat it as such. In Texas, the permitting process is streamlined and, crucially, predictable. Companies know the rules. They know the timelines. They know the costs. They can model their investments with certainty. State and federal tax incentives are aligned to encourage exploration, production, and innovation. The political leadership in Texas and in Washington, regardless of which party is in power, understands that a booming energy sector funds schools, builds roads, and creates high-paying jobs. This brings us to the Houston hub. Why is Exxon consolidating in Houston? It's not just about lower taxes, it's about the ecosystem. Houston is the undisputed capital of the global energy industry. It has the largest concentration of engineers, geologists, and technical talent on the planet. It has the infrastructure, the refineries, the service companies, the ports, and most importantly, it has the political will. This entire ecosystem is designed for one purpose: to get energy from the ground to the global market as fast and as efficiently as possible. And nowhere is this clearer than in the boom of liquefied natural gas, or LNG. While Canada has spent a decade debating if it should build LNG export terminals, the United States has been building them. According to the U.S. Energy Information Administration, EIA, U.S. LNG exports are forecast to surge from 11.9 billion cubic feet per day in 2024 to nearly 15 billion by 2025, and are projected to hit over 16 billion cubic feet per day by 2026. The U.S. is aggressively positioning itself as the primary energy supplier to a desperate Europe in a hungry Asia. It is filling the exact vacuum that Canadian policy created. The United States is playing chess. Canada is playing checkers. While Canada debates the morality of its production, the U.S. is focused on the speed and volume of its exports. The result of this policy-first strategy is staggering. In 2024 and 2025, U.S. oil production has shattered all-time records. The economy in Texas is booming. This creates a virtuous cycle: energy independence, more stable domestic gas prices, and immense geopolitical power. The U.S. does not need to ask other nations for energy. It is the nation that others must ask. This is the American boom. It wasn't an accident. It was a choice. It was the direct result of a policy environment that treats capital as a partner, not an enemy. Irrefutable evidence, the data. This is not a theoretical debate. The numbers are clear. The data is undeniable. Let's follow the money. First, let's look at capital expenditure, or CAPEX. This is the real-world money companies are spending on new projects and equipment. According to the Canadian Association of Petroleum Producers, CAP, total upstream capital spending in Canada for 2025 is forecast to be around 41 billion Canadian dollars. That sounds like a lot, But let's look at the U.S. global upstream spending in 2024, according to the International Energy Forum, topped 600 billion US dollars. North America, led overwhelmingly by the United States, accounted for over one-third of that. We are talking well over $200 billion. The Permian Basin in Texas alone sees more capital investment than all of Canada combined. This isn't a gap, it's a canyon. The money has already moved. This is the physical proof that investors have voted with their wallets and they have chosen the U.S. Now let's look at the human cost, the job flow. While the U.S. energy sector is adding jobs, the Canadian economy is stagnating. Statistics Canada, their own government agency, reported no net job growth across the entire country for most of 2025. Canada's unemployment rate recently climbed to 7.1%. Its GDP shrank by 0.4% in the second quarter of 2025. The Exxon layoff in Moncton is not an isolated event. It is the tip of a much larger, colder iceberg. It confirms the pain that families in Alberta have felt for years, a pain that is now spreading across the entire Canadian economy. Finally, let's look at the future. Production. This is where the story gets twisted. The media often portrays this as U.S. production is booming, while Canadian production is collapsing. That is not the full truth. The truth is more complex and more damning. Canadian production, despite every political obstacle, has actually hit record highs. CAP reported a record 8.9 million barrels of oil equivalent per day in 2024. This is not a story of a dying industry. This is a story of an industry that is succeeding in spite of its own government. But now, look at the scale. Canada's 8.9 million barrels, compared to the U.S. forecast of 13.5 million just for crude oil by 2026. This is the real great divergence. It's not that Canada is failing to produce. It's that its potential is being suffocated. The U.S. is in a rocket ship, accelerating its dominance. Canada is in a sports car, flooring the accelerator, but with the emergency brake pulled tight by its own government. The numbers do not lie. The capital has fled, the job market is stalling, and the production gap is widening into a chasm. This is the policy-driven great divergence, proven inarguable by the data. So what does this all mean? Exxon's departure from a small call center in Moncton is not a tragedy. It is a rational, logical, and predictable business decision. It is the clearest symptom yet that the great divergence driven by policy is real. Canada, a nation with arguably the richest energy endowment on Earth, is choosing this path. It is choosing to prioritize ideology over economic reality. It is choosing to build walls of bureaucracy while its greatest competitor builds pipelines. And the Canadian worker, the Canadian family, is the one paying the price. Capital has moved, the jobs are following, and this capital flight isn't just limited to big oil, it's happening across sectors. In our next video, we will investigate the full list of major companies that are quietly moving their operations out of Canada, and what that means for your pension and the value of the Canadian dollar. But this leads us to the most important question. Looking at these hard data, do you believe Canada's current path is a reversible policy mistake? Or is this the beginning of a permanent economic decline for its most critical industry? Share your thoughts in the comments below.